Hi, everyone. Dale Pinkert here at TradeGate Hub, joined by Luke Roman, at Luke Roman, author of The Forest from the Trees. And Luke, thanks so much for being here. The world changed yesterday. I got Powelled. He finally had me convinced, Luke, that he was going to stay tough, and he wasn't mean yesterday. So is the market making too much out of the fact that we already knew they were only going to go a half in December?
You know, I think it might be. I mean, I think the bigger thing is really you're starting to see things really roll over. I mean, the Atlanta Fed's GDP now aside, which I have no idea what they're looking at with their 4% real GDP estimate. The Chicago Fed yesterday collapsed. I think if Powell would have talked yesterday without the Chicago Fed having collapsed the way it did, maybe we would have gotten a different outcome. But I think it's very, and you look at some of the employment numbers, Challenger Gray and Christmas numbers this morning, jobless claims, housing, you're seeing a lot of things really roll over. So I think there's sort of this growing body of evidence to suggest that this, and so I think it was sort of the cherry on top of that, or maybe just that was sort of the tinder to the spark.
Come on, the guy flips more than a hamburger.
Oh,
when you finally believe him, right? So with this happening, with Powell making this concession, and probably wisdom, because he doesn't know what he's already done, what the impact's could be in 6 months. 9 months is when we'll really feel it, right? There's a lag in this policy. Is this an all clear? Here's a trend line, Luke, that I'm not talking about, just technicians, but the whole universe, including maybe even extraterrestrials, are looking at this downtrend line from here. And, we're on the verge of a breakout. Can we have a melt up? Because things have been compressed for so long. Basically, when I look at this, it doesn't look like the bear market, how the bear market felt. Do you know what I mean? It felt worse than it looks.
Yes, yeah, it felt like at those low points. That's when it started to feel correct, or it started to look like it felt.
Yeah.
But I agree. Other than that, it was pretty. You look at that chart; it looks pretty orderly, right?
Yeah, exactly. That's why people ask, and I don't know about a lot of people. I guess they could have conviction on the breakout. But 20 VIX makes me a little bit. There is all extreme complacency in the market, but I'm looking for what could derail it. And I thought until yesterday there might be one more pop up in the 10-year, but I don't know if that's as likely. You see, we had this wedge. I thought we were coming out of here, and I thought he was going to be a hawk, so that could have driven a dollar correction and sell off in the market. But no, it looks like straight ahead. And this is something we also talked about for quite some time, that we needed a bear market in the dollar to.
It's breaking down now. Yeah, and it's. I mean, I think we could have a melt up in the short run in equities, just because
of this.
Ultimately, because of that. And what's really interesting is something we've started highlighting to clients is he's in a really he's been in a really tricky spot the whole time. But the fact that the Fed is now moving into an operating loss, or has moved into an operating loss, puts him in an extraordinarily tricky spot, because the Fed operating loss is functionally indifferent from QE. And this isn't well understood. Yeah, it's not well understood at this point. But when you look at when he moved into an operating loss, the dollar's been down since. And that makes sense, because if Treasury spends more, and the Fed, with an operating loss, is effectively has a what is it, a paradox, or a Hobson's choice, right? Hobson's choice is there is no choice. So his Hobson's choice is continue to pay out because of the operating loss, because he's raising rates, and he is now upside down. The Fed's balance sheet is upside down relative to the Fed's funding costs. He can pay out $200 to $300 billion next year, what is essentially a bribe to the banking system to keep reserves and reverse repo balances where they are. So that's sort of the happy outcome for inflation is $300 billion. That's $25 billion a month in QE. If the Fed came out today and said, if he came out yesterday and said, I'm doing $25 billion a month in QE, what would have happened to the market? What would have happened to the dollar, right? Exactly what we saw. So now he cannot do that. And if he doesn't do that, if he cuts the rate on RRP, if he cuts the reserve rate, the interest on reserves, you're going to have $5 trillion flooding into the economy looking for a home. And then the dollar's really going to go down. And then the market's really going to go up. So I think I'm increasingly, and again, this is a very new way of thinking to me. It's something that, we've seen this chart. It's been going around Twitter all week of, hey, oh my gosh, look at the Fed's operating loss, right? It looks like a chart of FTX of FTX's operating income. I'm increasingly of the mind that he's done what he can do. And so now he has this Hobson's choice of, do I bribe the banks $300 billion a year? And by the way, the more he raises rates, the bigger the bribe's got to be to the banks. Or do I start trying to cut the bribe on that I have to pay the banks? Or do I stop raising rates? Or so I think in the short run, it's very dollar negative. It's very liquidity positive. I think it's risk positive.
Right.
Now, to your point before, they've done a lot of damage to the economy by raising rates as fast as they have. And so I'm hearing things like, multifamily freezing up, right? And so we're not going to see that for probably 3 months, 6 months, maybe as long as 12 months. I would take the under on 12 months, but I think we're definitely be talking about it. So let's that's why I say I think in the short run you could get a bit of a melt up. You could get the dollar down, but
there are some cycles that take the market up into sell in May and go away.
Yeah,
And people were talking about the spring, summer for new all-time highs, and people thought they needed to be stabilized. But now you're seeing more people come around to it the way it's shaping up technically. That we could have that melt up, weak dollar. I want to validate your great call in gold. The last time we were on about a month ago, you were talking about the huge purchases by the central banks and what that meant. And it's been really a pretty tremendous rally since you
it's
called
had a
it.
nice little rally.
Yeah. And silver as well, closing it's over 22 now. So it looks like everything could be good. And I asked you, I said, well, what about buying the bonds? Because we talked about this, that, yields may have peaked, even though I flipped again. So I was talking about the bonds, and you said, well, it could work in nominal terms, but compare the money you could have put to work if you put it to work in TLT compared to putting it to work in the metals.
Yeah.
Or the pound. I don't know why the pound is stronger
I don't understand that one either.
than euro, Luke. I mean,
I don't get it.
is it because they have an ocean between them and where Russia could go to on land?
I don't understand that one. I caught a bit of the last move down in terms of what we were saying to clients in the pound and the euro and the yen. But since then, I've been thoroughly confused by this rally off the lows. When they had to bail out that the market is obviously seeing the Bank of England's move to introduce stability to the gilt market at the end of September as a positive. I don't understand that. It doesn't make sense to me.
Look, I know some people think we could go to 102, but I know that your followers will watch this, and look how much of a line in the sand this
Yikes.
104 level is. So you go back to COVID, and if I move us out of the way, there's been other touches back in 2017. That's a big level. So, closes under 104. I think a lot of the long-term dollar bulls will have to say that the bull is over.
And it's interesting when you start looking at it that way, whether it's just lucky timing, it starts to look very cynically like a move to try to fight inflation to minimize Democrat losses in the election. And then they sort of move on from that point, because you can see in the early part of 22, in the first half of 22, Treasury spending was down massively. So the U.S. really did implement austerity. The Fed tightened. So they engineered this dollar short squeeze. Kudos to them. But like I said before, now it's blown up in their face a little bit of you're darned if you do, you're darned if you don't. If you're Powell, right? How fast do you want to depreciate? How fast do you want to print money? You can do it slow by printing the bribe, or you can do it fast by cutting the bribe.
Always kind of felt that the dollar was an easy sacrificial lamb for them, and it would actually, a weaker dollar is going to make the inflation problem stickier, just nominally, right?
It'll make it stickier over time with a lag, but it also helps them, right? You pointed out the TLT. What we've been highlighting all year is that the stronger dollar hurts the treasury market and vice versa, because all else equal, the higher the dollar goes, the higher the FX hedging costs are, and your big foreign buyers, your biggest foreign buyers, private buyers of treasuries, hedge the currency, right? So they don't buy 10-year treasury yields at 4 back in 8 weeks ago. They buy them at 4 minus whatever it costs to hedge the dollar risk. Now, what most people don't pay attention to is these hedging costs. And if the punchline is that FX hedged 10-year treasury yields were negative 1% to both European and Japanese investors back at the peak. And so the point here is that the dollar as release valve does more than just help economic growth. It helps a treasury market that, particularly in the back half of the summer, needed a lot of help. I mean, we were getting a weaker dollar checks a lot of boxes, and they have the tools to do that.
So I want to move on to a few of the things that you send out, a couple of tweets that I find interesting. You were talking about Ghana selling their gold for oil, and I remember a story being portrayed as Russia looting Ghana of their gold. It was portrayed that way to finance their war effort. And I didn't know there was a trade going on here for oil. You want to talk about that a little bit?
I think it's a really interesting development. Let's see how it goes. But the reason I think it's such an interesting development is we have seen these emerging markets around the world suffer as the dollar rose this year. And part of the reason that is the case, you really have two components call it three components to how a stronger dollar hurts emerging markets. Component number one is just a global economic slowdown. Component number two is the increase or the currency loss or depreciation hurts their ability to repay dollar-denominated debt that they may have. And number three is, with oil priced and most commodities still priced mostly in dollars, they need to the price of oil goes up on them as their economy is slowing. So why I think the Ghanaian move is potentially so important in terms of using gold for oil is it would, if they can use gold for oil instead of dollars for oil, what it does is it frees up one of the three big baskets of dollar illiquidity. In other words, they can save the pool of dollars that they have been needing to export to buy energy, and save that for debt service, and save that for, to offset whatever stimulus internally, whatever, due to the slowdown in the economy broadly from the stronger dollar. So now it depends on what the miners do with the dollars, right? If they or with the Ghanaian what I can't think of the name of the currency out, but the Ghanaian currency, if they don't if they turn around and sell those for dollars, it's
Yeah.
a marginal impact. Depends on what the Ghanaian miners' costs are in. You know, that there would be some minor benefit in terms of increasing dollar liquidity in Ghana. However, it gives them leverage because if there is an understanding, and there's a lot of evidence to suggest there is an understanding in the rest of the world that the U.S. broadly and the U.S. in particular manipulate the price of gold to support the dollar, then you could, with certain energy exporters, arrive at an agreement to say, look, I know COMEX NYMEX gold oil ratio right now is whatever 1880, so that's what 23, right? 2022, so
Right.
it's 22 and a half. We'll do the deal at 30. We'll do the deal at 40 barrels an ounce. And if they start to trade at a gold to oil ratio out above the COMEX NYMEX ratio, that then amounts to a circumvention or a reduction of the dollar liquidity pressure being
Yeah.
placed on Ghana by virtue of rising oil prices and the stronger dollar, or excuse me, the stronger dollar
Yeah, and
through
that's
oil
been
prices.
relieved.
It's been relieved,
So let's
exactly.
see what they do now. Something that I was surprised about that you tweeted, and I want to know in what way. You tweet that the EU is waking up to the reality that the U.S. has been conducting economic warfare on it. So why don't you tell us what this warfare is that the U.S. Has been conducting? We didn't blow up the Nord Stream pipeline, did we, Luke?
You're going right for the jugular, aren't you?
Huh?
I,
Thought we'd make a little news here today,
oh,
but
you're going to get me canceled, Dale.
yeah, all right.
No, I don't know. I look. I can make a very credible case that the U.S. did it. I can make a very credible case the Russians did
Right,
it.
I know.
In the end, it doesn't really matter. The effects are the same, which is it screws Europe.
Yeah,
And the economic warfare, I think, has been, broadly speaking, convincing the Europeans to go along with these
I
sanctions
see.
on Russia, for starters. But then more
Okay.
recently, some of the stories have been, all of a sudden, you've seen the headlines from Europe saying, wait a second, this Inflation Reduction Act is subsidizing U.S. industry over European industry. This is economic war. This is not fair. And then you've also seen headlines of European leaders saying, wait a second, the American energy sector is profiteering on our misery. This isn't fair. And so it's
Okay.
better late than never. To me, it was obvious that Europe was screwing themselves by going along with this whole thing
Yeah.
7, 8, 10 months ago, but better late than never, I suppose.
Okay. So yeah, most likely, especially during the depths of the winter and during this misery, you're looking for NATO to be fractured. And what
I think
countries?
it's
What countries would go? Like Italy, Spain,
I think you're going to
Germany?
see much more realpolitik about the whole thing. Yeah, I don't know if I would go all the way to NATO completely fracturing.
Yeah, but
Um,
a few go run to Putin's arms.
yeah, and I think it'll be spun as, who's so far. So Hungary, I think, has been sort of a, getting exemptions. We don't have to go along with the cap kind of a thing.
Oh, okay.
And
Yeah.
that's what you'll see. Italy is not going to go along with the cap, or whatever the case is. Some of the more levered to it. We'll see. Everyone can talk brave when it's warm out. It's always interesting to me to watch these leaders talk bravely about it and
Yeah.
sternly, and they've never really been cold. Not
Yeah.
really cold. And
No.
I only say that because
Yeah.
I was an Eagle Scout, and I have been cold. I've done survival camps in -7-degree weather, and I assure you, once you reach a certain point, you don't
Yeah.
give a crap. It's, get me warmth. Warmth moves right to the top of Maslow's hierarchy.
Yeah. Yeah.
Almost more than food. So
I grew
let's
up
see.
in Chicago, Luke. So
You know, in one of those days, right, where it just
um,
you walk outside and it feels like your face hurts and you just got punched in the stomach just for going outside, right? You're like, what?
I,
Why do I live here?
I think when I was very young, I was immune to it because I'd walk miles to an
Yep,
outside hockey rink.
yep.
Anyway, I want to talk about WTI quickly. That we have all this OPEC stuff going on, but these are pretty good levels. And the interesting thing is how the gold shares never really sold off with the energy commodity itself. It was almost a completely different picture. So, I mean,
Mhm.
crude came off and the oils just kept running because I guess they were see that? It's
Yeah,
the opposite.
yeah. The shares never
So,
came off.
like, like they print money over a certain level. I'm wondering if that could be the case in the miners that once metals get over well above production prices, even though the commodity would come down, that the miners could hold up better than the commodity, just like the oil shares did.
I think it's
You think?
possible. I think it depends on the political situation, right? Because I mean, the other side of it is look, Ghana just said you have to sell 20% of your mine output to us. And so that is something to be aware of. That's not to say I expect confiscation or anything, but it's just one of these things where you have to watch. I think this cycle you could see that the metal as it relates to gold specifically perform in line with the miners, and I think the miners are going to do pretty well.
Yeah.
When you take a step back and look at these charts generally, whether it's the energy shares, whether it's the gold shares, I think we may quickly be coming to a point where there has been a period of time for the last 7 to 10 months, 6 to 7 months, where there's a belief that the Fed's going to get inflation back down to 2 or 3. And I think we still have on the come a recognition that I think investors need to be looking at the world and asking themselves, what do I want to own if inflation never goes below 6 to 8% for the next 5 years? Because I
Right.
may say next 3 years. And I think that's a very realistic scenario. I think it could be on the upside, quite possibly, depending on events.
Okay.
So I think you'll see, I think that might be in some of what we're seeing with some of these energy shares is just like, why am I going to sell? Like they can't, the supply side in particular for energy is so attractive for the price over time in terms of providing a floor. I think that's part of what you're seeing, this
And
peak
a
cheap
lot of
energy.
them pay dividends. They pay you to sit, and they have dividends, and they also have a yield,
Yep.
which is something people look for.
Yep.
So I'd like to wrap it with a tweet where you said that Putin's next surprise that causes the energy crisis is that he's trying to deindustrialize Europe. So I see how he did it in Ukraine. How does he doesn't deindustrialize that way throughout Europe, does he?
No, I don't think he's going to war in Europe. I think we're watching it in real time. When we're hearing natural gas is so expensive that big chunks of German industry has to shut down.
Okay.
That's a deindustrialization. We saw there was an article a few weeks back noting it was sort of triumphant. It was, hey, look, the Europeans are probably going to be okay for gas this year, and that is good.
Yeah.
I don't want anyone cold. I don't want that. None of this makes me feel happy. When you read the fine print, though, number one, what are they going to do next winter? No one knows. Number two, more importantly, how did they get to this situation where it looks like they were able to balance supply and demand? It was by dropping industrial production by 7 to 9%. Well, seven
Okay.
to 9% drop in industrial production is a borderline depression.
Draconian.
It's very draconian. So it's a deindustrialization. And so it's really around that
Right.
energy. It goes back to the Europeans need energy sovereignty. And as long as they have to buy energy in dollars, they are not energy sovereign and they will not be. And as long as these sanctions remain in place, you're going to continue to see the deindustrialization of Europe, unfortunately, just on a cost basis.
Wow. To just squeeze, not because the business model failed,
No, no,
because
it's
right.
yeah.
Yeah.
I mean, it's exactly it. You
Really a
saw
tragedy, isn't it? I mean, good businesses and industries that
It's
are
a
just
horrible tragedy. It's a
being
horrible tragedy.
strangled to death by this.
Being strangled to death by this, and it's really, in my view, around defense of the dollar system. And
Yeah,
people say, why would the Germans do that? Like, I'm of German descent. My grandfather spoke German. Germans are a lot of things, but they're very good engineers and they're very, very rational. A lot of times to a fault, as I say, as a German. And the optimal solution was Nord Stream 2.
yeah,
Cheap gas in nearly infinite amounts from the Russians, piped directly into Germany, would have powered German industry cheaply for decades. The problem was that and you can go back, and I could cite chapter and verse of U.S. officials going back 15 years about Russian gas, and they never say it, but priced in euros. If the Europeans can buy
yeah.
gas cheaply in euros from Russia, that is a threat to the dollar status quo system. It would ultimately be really good for the world. It'd be really good for the United States.
It would
But
be, because people feel it wouldn't be if we moved away from the dollar system.
it would be bad for Wall Street, which is usually all you hear talk about.
Oh,
It would
who
be
cares?
it would be bad for certain interests in Washington. They
Yeah,
would
who
not be
cares
able to
about
write
them either?
deficit. But look, the
It'd be
dollar
good
system.
for us.
Oh yeah, the losers under the dollar system have been the U.S. middle class, the U.S. working class, and U.S.
All
political
right.
stability. And so, if you change
I
that
thought it was
system,
all my fault. I was feeling guilty. Thank you for, yeah, it has been, it has been an up and down, intense journey.
yeah,
Through what were the best of times in America, right?
yeah, and
They were.
you'd still use the dollar. I mean, the dollar would still be the reserve currency, but
Yeah,
you would replace Treasury bonds as the primary reserve asset with I think, gold,
yeah,
and goods. Basically, you would settle in goods, net any amount left over in gold, and that would be a threat to the Treasury market, and ultimately, because of that, the dollar, because the Fed would have to print the money to buy those bonds that weren't being bought anymore. So you've
yeah,
got this, from a purely engineering standpoint, what the Germans were doing was making perfect sense. Once you layered the geopolitics, and particularly the U.S. dollar geopolitics as it relates to Washington, Wall Street, that's they miscalculated. The
okay.
Germans miscalculated.
Is the Fed miscalculating with the CBDC that it's going to be accepted by the American public?
I am not a fan of the CBDC.
Is it going to happen, Luke?
Probably. I do think.
So they're going to know when I'm drinking a milkshake. And you know what? Regarding the milkshake, no one's drinking milkshakes with the Dixie at 104 anymore as much, are they?
No,
The milkshake theory. So
no, that you'll get the dollar. If you get the dollar down, you'll get risk up. You'll get
yeah,
U.S. Treasury bond demand to come back a bit. You'll get inflation back up. You'll get risk. You'll get economies start growing again. It buys everybody time, but
yeah,
yeah, it's very interesting time. We'll say that.
yeah. Everything goes up when we debase,
Yeah,
right?
that's it.
You
That's
could
it.
be long the world
Yeah,
when the dollar's bad.
you can. That's exactly what you do when the dollar's weak, and ultimately that's the U.S. doesn't care about the world. The U.S. government doesn't really care about the world, with a few exceptions, but they do care about themselves very, very deeply. And so once those Treasury auctions started getting punkish, we had a
Yeah,
10-year auction with a 3.5 basis point tail on it. I mean, that was
yeah.
I had a senior somebody in a senior seat who's been in this business a long time DM me. He goes, that was basically a failed auction. You're never going to get a failed auction nominally in the United States for treasuries, in my view. But you were getting some really punkish auctions with the dollar getting to where it was. And so, yeah, they don't care that they're breaking Ghana, China, Japan, any of
Yeah.
these places, but they care when their own gravy train with biscuit wheels starts seeing the wheels come off.
Yeah, it'll be interesting to watch all the hijinks around the debt ceiling coming up in a month or so.
That's another thing that could totally make this. You could see strong dollar come back. You could, it's getting
This
very,
is the
very
most
political.
difficult trading environment I've
100%.
been in a long time.
I actually, that was a title of a report I wrote a couple weeks ago. This is the most difficult environment I
It's
can remember.
treacherous
It
because if you
really
want
is.
to hold something for more than a day or even interday, there's all kinds of red headline risk all the time
Yeah,
in
you
the
either need to
market.
have a super long time preference,
Yeah,
or you need to be on your screen with stops like, you know,
I'm going back to 15-minute charts for a while, I think, Luke.
yeah,
Shorten
yeah,
the TF.
yep.
Uh, really, you opened our eyes to some things today, Luke. Really appreciate you coming here and sharing everything with us and your work, and recommend people go to your website uh, and check out your writings and consider subscribing so that they could hear more of what they heard today. And always rooting for you, and you are an important part of my intelligence gathering. And
Thank you very much.
great call on the gold, Luke. I hope you and your family have a great holiday season, and
Likewise, you too.
all the best to you, my trading warrior brother.
Oh, well, thank you very much. I hope you have a great holiday season as well, Dale, and thanks for having me on.
There you go, everyone. Luke Roman, follow him on Twitter at Luke Roman. Take it easy, buddy.